Welcome back to the Deep Dive. Today, we are taking the ultimate shortcut to understanding the global luxury spirits market. We're tearing into the recent financial year 2025 results for Pernod Ricard, one of the absolute giants.
It's an incredible report covering the period that ended, June 30, 2025?
Uh,
And it's so fascinating because it gives you this real-time snapshot of all the pressure points in the global economy right now. I
exactly.
mean, when you're selling high-end spirits everywhere from Shanghai to Sao Paulo, your results are going to reflect global volatility instantly.
Right. So our mission here is to really trace how their portfolio navigated what they themselves called a perfect storm. We're going to contrast the hotspots, and we're looking squarely at India against the areas facing, major headwinds.
China, firstly.
China and the crucial global travel retail segment.
And I think what's absolutely critical to understand here is the context. FY 24-25 was just so disruptive. The challenge for management wasn't just about revenue. It was this tightrope walk, balancing long-term brand investment, which is the lifeblood of luxury, with the need for aggressive margin expansion.
All while fighting off economic pressures and these crazy currency swings.
It was an intense balancing act.
Okay, let's get into those headline numbers because on the surface, they look painful. Total reported net sales came in just under 11 billion. That's a 6% drop from
Right.
last year.
And if you just saw that number, you'd think consumers just stopped buying premium spirits overnight.
Yeah, exactly.
But that's why we always have to look beyond the reported figures. The real operational health is measured organically, without the currency impact. And on that basis, organic net sales were only down by a more moderate 2%.
Okay, 2%. That's more manageable.
But here's where we see the first real sign of resilience. Their overall organic volume actually grew. It was up by 2%.
Wait, hold on. Volume is up 2%, but the sales are down 2%. What is that? I mean, what does that tell us about the consumer?
It tells us two key things. One, people are still buying spirits. That's why volume recovered for the third semester in a row. But two, the mix is suffering. Consumers are either trading down a little or the growth is coming from lower-priced markets or brands. And that puts just intense pressure on efficiency.
And efficiency is where they really shined, which is what I find so interesting. They managed to hold the line on profitability even with those sales challenges. How did they pull that off in such a tough environment?
It comes down to really disciplined surgical internal execution. They achieved a very strong plus 64 basis points of organic operating margin expansion.
Okay, so for anyone not in finance, a basis point is 1/100%. So 64 that's a pretty significant gain.
It's a huge gain. It means they made almost 2/3 of a percentage point more profit for every euro of sales.
Yeah.
Despite inflation, despite everything.
And how do they find the savings?
It was all supported by the completion of a massive pre-planned 900 million efficiency program that ran from FY 23 to FY 25. This wasn't minor trimming.
No.
This was streamlining logistics, optimizing supply chains, all the heavy internal work that lets you weather these external storms.
But even with that incredible discipline, the reported numbers still took a beating. Reported profit from recurring operations was down 5%, and earnings per share EPS fell 8% to 7.26. That foreign exchange headwind is like a ghost in the machine, just dragging everything down.
It is. It's the unavoidable macro penalty.
Yeah.
Imagine you're running a global business. Your store in Turkey is doing great in lira, but when you convert that back to euros for the corporate report,
The currency has collapsed.
exactly. The conversion shows a loss, even if the local business was brilliant. And that's what happened with currencies like the Turkish lira, the Nigerian naira, and the Argentinian peso. They were the main drivers of that negative hit.
So it's basically a punishment for operating in these high growth but high risk markets.
Precisely. And it didn't just hit revenue. It also pushed up their cost of debt to about 3.2%, which lowered the EPS even further. They only sustained the reported margin because that 900 million efficiency gain perfectly canceled out the negative FX.
Right. It's a story of internal strength versus external chaos.
That's the perfect way to put it. And that brings us to the geography. Their diversified footprint across the Americas, Europe, Asia. That's their strategic strength. When one market collapses, another can pick up the slack.
And the proof is in the numbers, right? They gained or held market share in 12 of their top 17 markets, even in this storm.
They did.
And nowhere is that regional split more dramatic than in Asia, which was down 4% overall. It really is a tale of two different economic realities. You have China hitting a wall and then India just exploding.
Let's start with headwind. China. Sales there fell sharply. A staggering 21% drop.
Wow, 21%.
Yeah. And it was driven by two major factors. First, the macro environment, weak consumer confidence, people are just spending less on luxury. But second, there was a really specific, painful issue with distributor inventory.
An overhang, what caused that? Was it just slow sales?
It was more strategic. Distributors were anticipating the end of a big anti-dumping investigation, a trade dispute, basically. They bought up massive amounts of stock, betting that prices would spike afterwards.
And they bet wrong.
Well, the situation stayed volatile, and they got left holding all this inventory. So the company had to slash shipments to them. That's what really hurt brands like Martell and their high-end scotch.
Okay, that makes the 21% drop make more sense. It wasn't just consumers, it was a channel correction. But now, let's go south to India.
India is the shining star, up 6%. Just dynamic consumer demand and this incredible wave of premiumization.
The rising middle class.
Exactly. And the key detail we pulled from the sources is just stunning. Jameson is now the #1 imported spirit brand in India by volume.
That is a massive long-term win. They've perfectly captured that trend.
Huge. And they found other bright spots too. Turkey saw strong growth with Chivas and Valentine's. South Africa was strong. But like China, they also saw sharp declines in places like South Korea and Taiwan. So a really complex picture.
And moving over to the Western markets, it feels more like stabilization. The Americas down 3%, Europe down 2%, but flat if you take Russia out. The U.S. market stopped its free fall, right?
Yes, sellout stabilized, which is crucial. But the real growth pockets tell you where the future is. Canada was up, driven by Jameson and, significantly, ready-to-drinks.
RTDs, yeah.
And Brazil had great results with Beefeater, Royal Salute, Absolute. It shows the strategy. When the super high-end slows down, the mass premium brands in emerging markets have to fill that gap.
So when we break down the portfolio, the big strategic international brand segment was down 4% overall, but the pain was really concentrated. It all comes back to cognac.
Martell. It saw a sharp global decline of 20%. And this wasn't just a simple consumption dip. It was directly tied to those China issues we talked about, plus this operational knockout blow.
The cognac suspension in China duty-free.
Yes, since December 2024. And you have to understand how devastating that is. Global travel retail, or GTR, is where travelers buy duty-free luxury goods.
It's a massive channel for a brand like Martell.
It's core. So when you lose access to one of the biggest duty-free markets for high-end cognac, the entire channel suffers. GTR was down a heavy 13% for the year, and it basically dragged Martell down with it.
So Martell and Ricard, which was down 5%, really struggled, but not all the premium brands did. What were the success stories?
Irish whiskey just continues its relentless march forward. Jameson showed low single-digit growth globally, and Absolute was growing in every region except Western Europe, which was mainly a problem in Germany.
It just reinforces that the whiskey and vodka staples are really resilient, even when luxury gets hit.
They are, and that performance shift really dictates their strategy going forward. You see them maintaining high brand support. A&P spend is holding at roughly 16% of net sales. That's a sign of confidence.
And they're targeting that spend, right? Prioritizing the U.S. market.
Yes. And they're actively managing the portfolio.
Huh.
Disposing of the Imperial Blue business and their wine segment. Those moves are meant to be margin accretive. They're shedding lower margin businesses to focus on the profitable core.
And the push into convenience and new categories is huge. They're accelerating innovation in the ready-to-drink, or RTD, space. And they set a really aggressive goal there.
They did. The official goal is to triple their RTD footprint in the U.S. over the next 3 years.
Triple it.
That shows you they don't see this as a trend. They see it as a fundamental shift in how consumers want their spirits.
And linked to that, they're expanding into non-alcoholic, capitalizing on that massive health and wellness trend.
Exactly. They launched a Ramazzotti Aperitivo Arancia 0.0%. It's critical. They recognize future growth isn't just about selling more alcohol. It's about capturing the entire spectrum of social occasions, even for people who are moderating or abstaining.
Let's zoom out to that consumer data, because it explains why that strategy is so essential. We're seeing real demand moderation, especially in the U.S. And the reasons why are fascinating. 45% of consumers cite financial reasons for drinking less.
But 39% cite health and wellness. That split is so crucial. We used to think moderation was purely a wellness choice, but now nearly half are saying it's for financial reasons. That's a recessionary signal.
And you see it in the behavior. The data shows U.S. consumption frequency is down a bit, from 11 occasions a month to 10.6. But the intensity, the number of servings per occasion, is actually up.
From 2.5 to 3.0. That is the less but better phenomenon in practice.
Right, I'm going out less, but when I do, I'm going to have a good one.
Exactly. They're condensing their spending, which puts huge pressure on volume growth.
So looking ahead, they're calling FY26 a transition year with performance skewed to the second half. That's basically a warning to investors to brace for a tough start.
A very tough start. They're explicitly saying to expect a sharp decline in the first quarter, and it's due to several things hitting at once. More inventory adjustments in the U.S. and China, an excise policy change in India, and the GTR cognac business only coming back online in Q2. They're clearing the decks.
And to prepare for that, they're launching another huge efficiency program, a $1 billion program for FY26 through FY29.
That's right, a new push, all designed to support margins over the medium term. It's absolutely necessary.
But I have to ask, they just finished a massive $900 million program. Can they really find another billion in savings without it starting to impact the quality or that luxury feel of the products? I mean, are they scraping the bottom of the barrel?
That is the critical challenge for management. The first program probably hit all the obvious stuff, supply chain wins. This next billion requires deeper, more surgical cuts. But their confidence suggests they think those levers exist, and they have to pull them to protect the margins they need for long-term brand investment.
So if they pull off this transition, what are they targeting for the longer term?
Their medium-term outlook for FY27 to 29 shows confidence. They're projecting organic net sales growth between plus 3% and 6% per year on average.
And margin expansion on top of that?
And margin expansion on top of that, yeah, driven by that new program. They're betting that global premiumization trends will come back once all this macro uncertainty passes.
So, to summarize this whole deep dive, they navigated a really fractured FY25. They got that margin resilience through intense internal discipline. That $900 million program was their lifeline, and it helped them fight off severe volatility from currency and regional collapses like China.
And the fractal lines are so clear. Martell and China are hurting, while Jameson, Absolut, and India are winning. The future battleground is all about adaptation, tripling down on RTDs and expanding the non-alcoholic portfolio to meet those evolving demands.
And for anyone watching the luxury sector, their discipline on cash flow is so important. They're normalizing their strategic investments, bringing that figure below $900 million in FY26. It just shows that balancing act between securing aged spirits for the future while staying agile today.
It is the ultimate balancing act.
We saw the data today. The single biggest driver for consumer moderation is financial strain at 45%. So if the global economy stays sluggish and inflation keeps squeezing households, how quickly can these new efficiency programs and strategic shifts really offset deep-seated, cautious spending? That fundamental question about the consumer's willingness to splurge is what you should be watching in the quarters ahead.